Your life journey doesn't stand still, and neither should your wealth. Welcome to Wealth on the Move, the podcast. All right, welcome back to another episode of Wealth on the Move, the podcast. I'm your host, Will Hoffman, founder and president of Hoffman Wealth Management. And like we like to do every quarter, we're going to talk about the markets, what it did last quarter, what we see looking forward this quarter, and returning our guest, Ryan Dietrick, Chief Market Strategist for Carson Wealth. Ryan, thank you for joining us on Wealth on the Move, the podcast.
It's like returning champion or something. I'm teasing. I don't know. I'm excited.
Yes, returning champion. The most popular podcast episode that we've had so far was the last time you were on.
Well, I think the timing of that helped. I know we met 6 months ago, and there's an old saying, the higher the VIX, the volatility index, the higher the clicks. My old friend Phil Perlman said that. I think it's 100% true. Well, we can't make guarantees in this world. It's like 99.9% true that, yes, when the market's crashing, like the last time you and I got to do this, volatility is higher. But I will say, I've got my hat here. There it is.
Nice. There it is. The Wealth on the Move ball cap.
I have a meeting after this, so I was going to wear it. I don't want to mess my hair up too much.
No,
there's my hat. So thank you for that. I actually wore it. I think I got it when you sent it to me a week or two ago.
Yeah.
So yeah, just wore it around the other day. I always like wearing that stuff. But listen, I'm really excited to be back. Obviously, a big fan of you, big fan of the podcast, and an honor that the first time I was on did well. So let's try and do that.
I'll tell you why you're excited to be on here.
All right, let's hear it.
Because something really strange. We're talking about the fourth quarter, and something really bizarre happened to kick off the fourth quarter. And speaking of kickoff, it is not often that the Cincinnati Bengals beat the Pittsburgh Steelers, but
no, it's not.
That's and I know what kind of market analyst you are and kind of how you like to have fun with this. So I was trying to look back at the last time or the Bengals beat the Steelers.
Okay.
And especially two in a row, because that's two in a row that the Bengals have beat the Steelers.
That's true.
So I wanted to look back and see what the markets tend to do when that happens twice in a row. Ironically, the last time it happened twice in a row, actually 2020 to 2021, it happened 3 times in a row. We don't like to talk about that, but the Steelers had a nice winning streak. Bengals beat us twice in a row in 1998, kind of a wild market.
Yeah.
Beat us twice in a row in 2009, coming out of a pretty wild market. So but the major indicator is there is no major indicator. It has zero correlation to the market when the Steelers beat the Bengals twice in a row. The Bengals beat the Steelers twice in a row.
Yeah, I'm sure last time I was on, we joked about when a team from Philadelphia wins a major championship, specifically a Super Bowl or World Series. And I mean, listen, I know the year's not over yet. Good chance we're going to have a pretty good year here, right? I mean, I think it's safe to say without some major calamity coming here. But you could argue after the Eagles won, we did have a near bear market.
Yes.
I mean, it was anything but easy. This year it was like, market's up, ballpark 12, 13, 14%, low double digits. Let's call it that. It's like, yeah, but I remember early April. You remember early April. Listeners, clients remember. I mean, I heard people that reached out to me, Will, that I hadn't heard for 20 years. They knew me from what I do for a living. They see it. And they're like, oh my goodness, what Trump is doing is going to wreck the economy. It's going to wreck the stock market. He's going to end it all. Like that was the attitude. Everybody, not everybody. Most people had, and even if you say, I'm not getting political. I'm just saying that's what it was. Maybe you voted for Trump. You're still looking around like, what in the world is going on with tariffs? Right. What is he really? Is he truly trying to cause a recession to, push his hand a little bit? And there were some scary moments. We had a 10.5% drop in 2 days,
right.
2 days after Liberation Day, aka Obliteration Day. Now, fortunately, those 6 months later have been literally one of the strongest 6-month rallies we've ever seen and least volatile, right? We've had some bigger swings lately in October. I think that's fine. We get into some of the weeds of this stuff, but it's truly been like a 36% rally in 6 months without a lot of big swings. I mean, kind of, if everyone's thinking alike, someone isn't thinking. Back in April, when you and I got together, we talked about some potential positive things out there. Sure enough, we avoided the comment again. No recession. Economy still looks good, and this bull market's alive and well, and it's a global bull market. I know we talked about that probably back in April, too. We think there's opportunities around the globe. Don't want to give it all away, but just setting the stage. It's been a heck of a year, but a good year for investors.
Yes. Yeah, when think about if you would have followed one of the old mantras on Wall Street, sell in May and go away, what you would have missed this year.
Yeah. Every month up.
Right.
Every month has been higher. Yeah.
So let's talk about that. What was the catalyst to the recovery, if that's the right word to use, or just the catalyst to this bull market that we've seen over the last 6 months?
Absolutely. So there's a few of them, I guess. Big picture, why'd we bottom? In April when you and I got together after that I'm going to call it a near bear market. So I don't make these definitions. 20% down is considered a bear market. We were right there, right? I mean, it felt like a bear market if you were in the middle of it, like we all were. It was very uncomfortable. I mean, we were pretty bullish. We still are. We've been overweight equities. My team manages about $6.5 billion. So the stuff I'm talking about today, it's how we're managing a lot of money. All right. At the end of the day, I mean, President Trump came out pretty aggressive on trade, and then he pulled back. I mean, that's the real simplistic way to put it. I want to get too in the weeds on this, but there's something called a tariff rate, right? What is a tariff you're going to put on goods and services or goods that come into your country? At the start of the year, is around 2 to 3% in the United States. Most people, we knew President Trump ran on this. Okay, he quoted this, his quote, not mine. Tariff, the most beautiful word in the English dictionary. He ran on that, so we knew there'd be tariffs coming. Most people thought, maybe 10 to 12% tariffs, maybe 15 would be pretty darn high. When he held that piece of paper, or that board up on Liberation Day, and everyone kind of squinted and looked, we realized, oh my God, it's 25% effective tariff rates. That's why the market crashed. Now, he pulled all those back, and take a wild guess where the effective tariff rate is right now. 12%.
Right.
Okay. So there's this book called Art of the Deal. You come in kind of crazy early, you freak everybody out, and then you get your deal. I don't know if it worked or not. I'm the markets guy. I'm just saying now we've had one of the strongest 6-month rallies ever. And then to put the cherry on top, okay, that's tariffs, that's trade. We pulled it back, or President Trump pulled it back. Earnings drive long-term stock gains. We continue to see record earnings. Every single earnings season comes in better expected. I mean, it's early this earnings season. Time you and I are doing this. Financials kicked it off at the start of earnings season. Financials supposed to be about 12% year over year. After some of those big banks came out with huge, strong earnings, now look at almost 20% year over year earnings growth. Now we're going to get technology and all the big AI names, all that stuff coming up. But if earnings are at all-time highs, profit margins hit new cycle highs. And it's not just a U.S. story, everybody. There's earnings coming around the globe. And one more thing on this, everybody says, well, it's only 7 companies. It's only 7 companies. No, it's not just the Mag 7. Yes, the Mag 7's making most of the money. I'm sure you're a Bulls fan back in the day. You like Michael Jordan?
Yeah,
I'm
Bulls
assuming.
fan now. Yeah.
Well, that's what I figured. Yeah, I mean, exactly. So, who didn't like Michael Jordan as a kid, growing in the 90s? Yes, they would not have won 6 championships if they didn't Michael Jordan. I don't think that's too much of a stretch to say. But you know what? It took a lot of other good players to
Bill
get there.
Cartwright was still an integral part of those teams, right?
Yeah, I mean, I'm from Dayton, John Paxson. All right, he's got statues in Dayton. Every little kid looks like me shooting the basketball. We all love John Paxson back in the day. We knew we weren't Jordan. We're like, maybe I could be Paxson, Anyway, now we're going to get on a real big rant going on 90s basketball. But the truth again is there's earnings coming around the globe or other areas. The 493, last comment, the 493. So the other stocks, not the Mag 7, the other 493. Earnings are supposed to be up like 7 or 8% this quarter. Yes, Mag 7's up about 14, 15. Okay, we get it. Those are the leaders. Sometimes you got to pay up for the leaders. There's always a leader every year, but the others are doing really well. And I think end of the day, Will, that's why the stock market's come back. That's why we've done so well. We've avoided a recession. Corporate America is strong, and the consumer that everyone left for dead 6-7 months ago is still okay. Are there cracks? Yes. In the labor market, there's cracks. Yes, there's defaults going up, auto loans. There's some issues clearly out there. Overall, though, still pretty solid still pretty solid consumer.
Yes. And I know you're the markets guy, and we spend our time on the behavior side, but when to me, that was all a behavioral reaction to.
Yes, it was.
We're always going to have the same behavioral reaction to uncertainty, but the market had done pretty well up until April also. And, in April, we're at all-time highs.
Mm-hmm.
So, you know what? There's some bad news coming. Maybe it was good fundamentals to capture some gains. Maybe we were nervous and, we start to see 2008 and 9 in the back of our minds. We start to see 2000 in the back of our minds and think, okay, this can't continue forever. And now there's some uncertainty. And here we are again at all-time highs. But here we are again at all-time highs. And here comes Uncle Sam. And instead of tariffs, now we're talking about the second largest government shutdown that we're in the middle of right now, and probably getting longer. It's October 23rd. Recording this, I don't know that there's an end in sight that you or I have seen, but how does this impact the markets now? The market's been pretty resilient through these last 20 or so days.
It has. Let's put a pin on that. I want to touch on one more thing. I'll get to that. People say all the time, like, oh, we just need like another bear market. We need another bear market. Listen, we had a 34% bear market in early 2020. Shut down the government. I'm
Yeah.
sorry, shut not the government.
Shut
Shut
down
down the
everything.
economy. We saw it. 2022 was a terrible year for investors. Stock market down 25%, and bonds, which usually are pretty safe, were down. Gold, which has been on fire. We can talk about gold in a little bit here if you want. Was flat in 22. Terrible year for investors. Then we just had another near bear market. We had like 3 bear markets in 5 years. Everyone go back in history. That's never happened before. All right. Now, yeah, we're up like well over 100% on the S&P 500 since all that started in 2020, again, led by earnings. But, this is kind of how these things work. I mean, I say this a lot. You can do yourself a big favor by every year come into the year looking for a 14% peak to trough correction. Why'd I pick 14%? Will, that's the average year. The average year sees a peak to trough correction of 14%. We, the Carson Group, committed this year bullish. We've been bullish for 3 years. People hated it when we were bullish this time 3 years ago. It is what it is.
Sure.
We said in our outlook, expect a 12 to 15% peak to trough correction some point during the year. You know when? Probably in the first half. Why is that? Because the first half of a post-election year is usually pretty choppy. The first quarter after a 20% gain is usually pretty weak. These things added up. Now, no, we didn't see a bear market. We also didn't see when President Trump held up that paper of Liberation Day being like that, but we said expect volatility. Burt White, our CEO, says volatility is the toll you have to pay to invest. I think it's 100% true.
It's a great analogy. Yes.
Yeah, I'm probably not allowed to say 100%. I know we live in a world of compliance. It's true, okay? I mean, volatility is the toll we pay to invest. Now, with that context out of the way, we'll talk about government shutdown. It's been widely...
Before we do, I want to ask you one more question, because you said you came into the year bullish.
Yeah.
What time constraints do you put on that? Because I would consider myself a perma-bull.
Yep. Well said.
Meaning in 2035, I think we're going to be in a better place from an economic standpoint, from a market standpoint than we are today. Is it going to be a straight line? We know it's not. We're going to have that toll we have to pay. But when you guys say you're bullish, what time constraints do you put on that? Is that for the next 6 months, for the next 12 months? How do you guys regulate that?
That's an excellent point. So we do manage different types of models, right? Tactical models, think 6 months to 12 or 6 months to 12 months. Strategic models, 3 to 5 years. I think when we're talking, when we do that, like in the media and I'm doing my thing, we're talking more strategic. I'm sorry. We're talking more tactical. More the shorter term, 6 to 12 months. At the start of this year, yes, we were optimistic. We were probably 71% equities in our 60-40 portfolio. So give it, if 60% is kind of, your market neutral portfolio, 60-40, we're about 71-72% equity. So not wildly overweight. We are much more overweight in 23 and 24. We kind of dialed it back a little bit because we saw the opportunity for some more volatility coming, and that's obviously played out. Lou Holtz, I know football fans, Lou Holtz said life is 90% you respond to something, 10% what happens to you. We came into this year not liking developed international, not liking Europe all that much, not liking emerging markets. By about February, March, we're with a really smart guy named Son of Varghese. He's our, VP Global Macro Strategist. He saw some of the stuff happening in Europe, specifically Germany. And maybe this is kind of, honestly, some of President Trump's policies. They kind of said, we're going to do it on our own. We're going to do some major fiscal stimulus. Four most dangerous words: this time is different. Sir John Templeton. If you hear that, run the other way. We were saying, we joked about it. We said, listen, this is different. Germany's doing some things. Europe's doing some things they haven't done in decades. It's going to create some growth and likely higher equity prices. Well, what happened? We added more for an RIA. We just actually crossed $50 billion a couple weeks ago. One of the largest RIAs in the country, fastest growing, which is really cool. Carson Group. But I think the pockets of big RIAs and ballpark our world, I bet before Liberation Day, we added a good amount of developed international. I bet we have more developed international than just about anybody else out there. So we say overweight equities, but when I say that, we say, listen, when in doubt, diversify it out. There's a lot of opportunity globally. And thank goodness we did, because the U.S. is down just more than just about everybody, right? I mean, their liberation, we took the brunt of it. A lot of other, like Mexico, was like up. I mean, a lot of other countries doing up. You said, well, I thought it was supposed to hurt them. I guess not. Anyway, so those are some big picture things that we're looking at. But to be diversified in this world, but still overweight equities, is how we see it. But again, to put a bow on it to answer your question, 6 to 12 months is probably what we say, because we can change our tune. We can change our tune quickly. I mean, that's the cool thing about being where I am. We can, the data changes, I change my opinion. What do you do, sir? That's the old famous quote too. You want to talk about government shutdown, or want to build on that? What do you want to do?
Let's talk government shutdown, because that's every headline we're seeing right now. But what we're not seeing is a really strong market response to this.
You're right.
I mean, is the market
yeah.
just priced in these 535 folks in Washington not
yeah.
getting along ever?
So what's fascinating about market? I mean, I love markets. You love markets. Listeners love markets. It's just fun to wake up and see all the crazy stuff going on and try to put it all together. Nobody has a crystal ball.
Case study in real life every day.
Yeah,
all day.
but something's a little, again, this time is different, honestly. There are those betting websites now that real money go into, and they're not just betting on sports. Okay, I don't bet on sports. I'm no good at that stuff. But people bet on markets, like who's the next Fed chairperson, who's going to be next president, will there be a recession. Well, one of them that was out literally when all was going on was how long the government shutdown will be. So this was out there, right? This is being priced in. Markets all about what's priced in, what's not. The betting markets, when the government shutdown started a couple weeks ago, was looking for like a 3-week shutdown. It was now, I mean, I don't know the exact number of time we're doing this, but they're looking for like a record, right? We are the second longest shutdown ever. Only the one before this, so late 18, early 19, was longer. I think it was 35 days. So this one could get to that point if we go through, I think it's November 7th, which, again, the betting markets are saying it's possible. And I'm not saying you should invest on the betting markets. I'm just saying that's a new piece of information that we have. Now, again, one thing we hammer home, a lot of other people, if you look at the last 22 government shutdowns, S&P's up during them. Now, a lot of them were like 1, 2, 3 days. That's kind of some random stuff. But the most recent one, it was 35 days, was up 10%. It had nothing to do with the government shutdown. It's because the Fed was a little hawkish, and the Fed became dovish, and the market rallied like crazy. And here we are again. The time we're doing this, at least, stocks are up since that government shutdown started, not by a ton. And honestly, we've had more volatility. I don't think it's anything to do with the government shutdown. It's because we haven't had volatility for a long time. We went 33 days in a row on the S&P without a 1% move up or down until October happened, and now we're getting more volatility. Even on the upside, we're getting bigger moves. I think that's perfectly normal. Maybe I call it a Charlie Brown shirt. Remember Charlie Brown shirt, that squiggly line?
Yeah.
Maybe that's what we do in October and a little bit of November.
October's traditionally a volatile month anyway, right?
Exactly. And it's also my birthday. My birthday is October 28th. So there we go. When's your birthday?
August 30th.
August. Okay.
Both 78 though, right?
We're both 78. Yes, we are. So my buddy Sonu, he's 78 also. I always say he's older than me. He was May. So Sonu's older than both of us. So Sonu's still the old man in the room.
He's your podcast co-host,
Sonu and
right?
I do a podcast called Facts versus Feelings, weekly podcast. We have a lot of fun and talk about the same stuff we're talking about right now.
Nice.
So I can make fun of him. Where were we? Oh, government shutdown. Yeah, I mean, the truth again, what do we hear? Well, this is Goldman Sachs data. I can't verify it, but I trust a lot of these big economists. Every week, the GDP maybe takes about a 0.1% hit. So we've been shut down several weeks. We've seen that throughout history. GDP does slow down. Why? Because people are losing jobs. People aren't getting paid. The government, a lot of people work for the government. That's kind of a lot of things are shut down. So the government does take a little. I'm sorry, the economy, it's a little hit. But the honest truth, Will, when you open it up, boom, you make it right back. And the reality, most people realize that by now. And that's just where we are. It's unfortunate. A lot of people aren't going to be getting paid here. I know people in the military aren't getting paid potentially soon. Maybe they're going to pull some strings in Washington to make sure that happens. A lot of people, though, that aren't getting paid very soon. And that's unfortunate. I mean, I'm not the political guy. It is what it is. It happened before. It'll happen again.
Just
and
wish
I'm not
these
crazy
folks
about it, but
could
where we are.
Get to an end result without bargaining with people's livelihoods.
Yes, we do. And listen, no one knows that election's coming up on November 4th. I would not be shocked at all if we were still closed through that, right? Maybe see how the results are, and then whatever team loses, so to speak, you'll call it teams. I don't know. Maybe they cave. It just doesn't seem like anybody, and I hope I'm dead wrong. I hope people listen to this, we're open. I want to be clear, but it just doesn't seem like there's a lot of pressure either way right now yet. But I think if you stop paying people in the military, well, pressure gets up there in a hurry.
There's a lot we disagree on, but the one thing I think we all agree on is those folks are heroes every day and
absolutely
deserve their paycheck. So hopefully these folks can get it settled and figured out. All right, one thing that I'm by no means I guess I'm not an expert on anything, but one thing I am not well read on and don't understand, and I'm hoping you can add some insight to, is gold.
Okay,
what in the world is going on with gold in 2025?
Well, there's an old saying. I guess you and I would have been like 1 or 2 at this time. There's no fever like gold fever.
Right.
I think, markets, I'm talking broadly speaking, go up, go down. You get these manias. Clearly, gold's been a mania. The best year ever on record for gold was 1979. I'm going by memory here, everybody. So like 120 or 130% on the year. Gold's pulled back a little bit lately, but gold was up like over 60% at the start of this week. Now, you ask yourself, if everybody's thinking like somebody's thinking, Journal Patent, I use it already, but I love that one. At the start of this year, I think people were bullish for the most part, feeling pretty good, for the most part. But the most common thing I heard, Will, was the US dollar is going to go up. Like literally everybody said that. Trump policies, whatever. Pick a reason. But it was why, The Economist, okay? The Economist they have quite negative anymore. Just go look at some recent Economist magazine covers. In late last year, November-ish, they had a $100 bill rolled up, flying into outer space with sprinkly stardust coming off of it, talking about the global U.S. economy, okay? So that to me was like, whoa, if the Economist is that optimistic and showing $100 bills flying in the air, they're pretty bullish. What if the dollar went down? And we openly said this on our podcast and our calls. We were one of the very few people saying this in late January this year. And what happens if the dollar goes lower? It tends to be a tailwind for international exposure. It tends to be a tailwind for metals. It tends to be, if you drop it, it hits your foot, it hurts. That's the stuff that does well. Well, last I checked, gold hurts your foot when you drop it. If you drop a lot, and if you drop a lot anymore, you're doing good because you made a lot of money. And we, the Carson Group, actually have we added about a 3% allocation to a lot of our different models back after the SVB crisis in April of 2023. It was not because we're some gold bugs. We were bullish. I was on record, middle of 23. And people gave me some weird looks on this one. I said, I think we're about to go in a period for years where gold and stocks do well together. Everyone thought, well, I have to have one or the other. No, you don't. You just look at the data, look at the history. We've seen periods of years. And Sonu looks at stuff from, inflation front and the spending and all the stuff going on. But the honest truth also, when did this gold recent bull market kick off? After the war started, right? The war started in Ukraine. What happened there? Again, I don't want to get political. I'm just the guy in the middle here. A lot of sanctions on Russia were put in place. Other people looked around and said, what's going on here? Let's buy gold because we can't trust each other. Let's just buy gold in our central banks. And we've all seen the charts. The central bank buying has just been off the charts. So you've got a dollar going lower. You've got a lot of uncertainty. You've got volatility and inflation. People think just because you have inflation, gold has to go up. 22 was like the most inflation we've all seen in our lifetime, probably most listeners. Yet gold is flat on the year. It's more on volatility on inflation when gold does well. But the truth, again, is central bank buying, all of these things combined have led to gold just having a truly unbelievable move. We never looked at gold like an alternative to equities. You think about a 60-40 portfolio, 60% stocks, 40% usually bonds. But in this day and age, that 40% needs to be more stuff, in our opinion. We always said gold's going to do a little bit better in bonds, and thank God we did, because our model's done really, really well, because fixed income obviously hasn't done all that great. Although bonds have had a decent year this year. Barclays Ag's up like 7%.
Yeah.
That's pretty good compared to the last couple of years. Clearly, it's nowhere near gold. I'll just put a bow on this. We can talk a little more if you want. Gold is about as overextended. Not saying you can't tell by looking at a chart. Gold's about as overextended as it's ever been. You can look at various asset classes. This is as overextended as any asset class has like ever been. All right. So I would not be shocked if 6 months from now gold was down from here. I didn't say anything too crazy. Maybe some consolidation would be perfectly normal. Yes. We still own gold on our models. Honestly, we said, Soda and I were joking the other day. This is when gold had like a 5% drop a couple days ago. We said, this is the first time we've ever had stuff on our models we were happy it went down. Because we don't want to see gold keep going up, because it means maybe something is really spiraling out of control here. But I think it does make a little sense. Talk with your financial advisor to add a little bit of gold, but maybe not right here. Maybe let it pull back, because it will. And I keep going. Last thing, gold's going up for about 3 years. Go look in history. Once these new cycles go, they go a lot longer. So I don't. This would be the shortest.
10 years is kind of like
yes. My friend,
we're not talking about short cycles there.
Yeah, it went up 11 years in a row. The last time, so I'm not saying I'm going to do that again. My friend J.C. Peretz pointed out if gold stops like right now, stop right now, it'd be the shortest bull market in history, the shortest bull market for gold in history. But it doesn't mean every year it's to be up. It doesn't mean every year it's to go straight up 30, 40%. But these cycles, they last a while. I think we're still in a major secular bull market for stocks. I'm going to be very, very clear. But again, that's some of the stuff going on with gold. It's truly fascinating. There is no fever like gold fever. It would be the easiest answer.
Remember that.
Yeah.
How much do you get into crypto and the analytics there? What thoughts do you have about what's been going on in the crypto
Yeah, I'm
market?
somewhat limited what I can say. I can talk broad, big picture. I mean,
Yeah.
we actually just recently added some ETFs which do have a little bit of crypto exposure. So again, by no means, like 10% of our portfolio. We're talking like 1% of our portfolio, maybe. But you look at it and it just won't die. There's all this bad stuff that's happened to that industry the last, we'll call it 10 years. I mean, Bitcoin itself, I'm going by memory here, I think I'm close enough for government work. I think it's had 6 different bear markets where it dropped 75%. Every one of them felt like the end of the world. They call it crypto winter is what they call it. But we come back every time. And they're now similar to the gold thing. You can love gold or hate gold. If people are buying it, well, it usually means it's going up. Well, listen, with those big ETFs that have come out, there's been a lot of buying, clearly in cryptos. You want to look at who's in the White House, what the administration is talking about. They're pushing crypto. They're really moving into crypto. With David Sachs is a crypto czar, right? We've never had a crypto czar in our country. I mean, it's kind of a made-up title, but, I like David Sachs. I think he knows what he's doing. So anyway, you've got some regulations going on, or deregulation, or maybe whatever word you want to use there, but some things pushing crypto forward, and you have just massive, massive buying. Now, the clear, honest truth, though, with crypto, there's kind of, I call it the Red Sox and Yankees, right? You got Bitcoin, Ethereum, Solana, your big ones. Then you got what they call altcoins. Some of those altcoins, and specifically meme coins, they went down like 2 weeks ago, like 90%, like overnight. Okay. I mean, Ethereum went down 20% just in the blink of an eye. I mean, the blink of an eye, 20 down 20%.
I mean, Bitcoin was
Bitcoin
close.
was darn close. So if you want to get into this world of crypto, I mean, talk to your advisor, make a good decision, but just know that literally, and it feels like it's on the weekends. I mean, I do follow it and I've got some, so I pay attention. It's like on the weekends when the crazy stuff happens. Okay. So just be aware, you might go to bed on Friday night and come in on Monday and you just lost 30% of your money. So if you got 10 grand in there and you're going to look at a 7 now and you can't handle that, don't do this stuff.
Yes.
Know that that's
I
the
agree.
way it works. That's the way this works. I mean,
well, and I mean, to go back to gold, commodities, sort of the same. They're which is why, I mean, they can be so volatile and so fast that you could miss being able to react. You have to be cognizant of that.
Yeah, I mean, listen, we're not short-term traders by any means. I don't think you are, and I don't believe most of the listeners of this podcast are. So if you're going to buy something, I mean, buy when it's scary. And I know that's hard to do, whatever that is. Start of the year, you say,
blood in the street, get your money in.
Yeah, like with gold. I mean, I wouldn't be surprised if gold pulled back 20% peak to trough sometime fairly soon. It sounds like a lot. It is a lot, but then you look at the move it's had, it would be normal because its 20-day moving or its 50-day moving average is way, way down here. So of course it's probably going to pull back. So have a I want to make sure I say it correctly. Plans are useless, but planning is everything. President Eisenhower, have the plan, write it down, because another old saying, when the moment is there to buy, you're not going to want to, because everybody on TV is going to tell you how bad it is. It's red in the sea. Everybody's scared. Everything's bad. Blood in the streets, like you said. But if you have that plan in place ahead of time, and if gold's the thing we're talking about, if crypto's the thing we're talking about, shares of Apple, not a recommendation for anything. I'm just saying, have a plan in place when it's there, because like in April, when literally a lot of everybody loves NVIDIA and loves all these tech stocks, they were cut down 30-40% because you had what's it called, DeepSeek. Remember DeepSeek was going to ruin AI? Well, that sure didn't happen, did it? But it felt like it there for a while. And then you had April, and a lot of these companies that are truly the strong ones in the market, they were on sale. They say the stock market's the only place things go on sale, but everybody runs out of the store screaming. I saw a lot of running out of the store screaming. Like if the suit you like is $800 and it's on sale for $300, you're going to go buy it.
Banging at the door, right?
For whatever reason. Well, I know the reason. We get into the psychology of it. When it comes to the stock market, most people, and I mean most people, do not think of it like that because we care about our money, our religion, and our family the most. And when those things are threatened, our brains are going to caveman times, just hide in the cave and don't worry about it, just hide and survive. But sometimes stepping out and taking a swing, if you will, when it's scary out there, if you have time on your side, which let's hope all the listeners do, and I'm talking like 5-10 years, there's some good values out there during these times of crisis. One more thing on this. Look at this the last couple of years, 2022, bear market, all right? 2023, we had the regional bank crisis early in the year. Pure panic in the streets.
Yeah.
August of last year, we had the yen carry trade unwind. Most people say, what's the yen carry trade unwind? Trust me, for 3-4 days, everybody was panicking over the first domino. Japan literally is having its worst day since 1987. back that first Sunday night we all went to sleep in August. Pure panic out there. And then you come into this year and you have a near pair market with Liberation Day. Every single year is going to have a bad day, a bad week, a bad month. 1997, there was one day, and I think it was in August or so, S&P lost 6%, okay? Just imagine if we lost 6% in one day now. I mean, the panic to be out there. Still gained 30% on the year. Now, I get it. A lot of years lost 6% in one day and didn't. But I'm just pointing out the fact that you're going to have bad days. You're going to have bad headlines. If you have time on your side, follow what Will's telling you, follow what financial advisors are telling you. Use those moments as opportunities. Maybe not necessarily add, just not to panic, because I can't tell you how many people told me back in April they were selling everything in their 401k. They were getting out. They couldn't take it anymore. And now here we're up 35% on the S&P since then. Bonds done well, and gold just went bonkers, like we said.
Last big headline I want to talk about is interest rates.
Yeah.
Looking at the prospect of probably another cut soon in this year. You think that's going to do anything to the markets? Is that going to, I mean, that kind of helps our bear case or bull case, excuse me, a little bit. And then the Fed chief is going to be up next year for conversation. What direction do you see all this headed?
Yeah, we're going to talk about the F word, huh? The F word, the Fed. The Fed, that's my F word joke. My other one is the F word. I'm talking to like other crowd. It's Fibonacci, if you know the Fibonacci retrace. That's my other F word. I've got multiple F word jokes. We'll leave it there, though. So
it's a kid show, Ryan.
I know. That's why we talk about the Fed. There we go. That's why we get all the ratings, you know. It's funny, like on my podcast, we were labeled adult material or adult content. And I was like, what? We never cuss. So be careful. Like, look at it. Like, some reason Apple labeled us. I'm like, we never do anything like that. You know, maybe I use my F word joke, but I don't say the word. I say the word Fed. So anyway, so make sure you're not labeled after I made my F word joke.
Yeah.
Sorry if I did. Anyway, so where am I going with this? The Fed. So we were on record at the start of this year saying the Fed should have been cutting. We thought they should have been cutting. So saw some things. Maybe the economy slowed down a little bit, but then Liberation Day happened, then the tariffs happened, and they couldn't. I mean, that's the truth. They couldn't cut then because you worry about massive inflation coming. Fortunately, we've avoided that. The honest truth, though, with the government shutdown, we don't have a lot of data. We don't have weekly claims on a lot of data, right? I mean, that's the truth. I know we're going to be at CPI data. By the time people listen to this, we'll have CPI data, but that's going to be dated, and who knows? The people that had to bring people in from, being furloughed to actually do their job, I don't think maybe they're not going to give 100%. I don't know if they get paid or not for it. But anyway, we think the Fed should be cutting here, right? You look at the cracks that are out there. The housing market obviously is weak. The labor market's obviously weak. Credit markets are showing some teetering. Regional banks have had some disappointing news lately. I think that's more company specific. I want to be very clear on the regional bank side. But the truth is the Fed probably should be cutting. Not a lot, because you hear about, the Fed's cutting. Well, the Fed cut in 2000, the Fed cut in 2008, the Fed cut a lot in 2020. Yeah, those are recessions, and they cut. There have been times, though, many times, where the Fed cuts without a recession, and those are usually like mid-cycle resets and things like that, usually positive. 21 of the last 21 times, Will, the Fed cut with market near all-time highs, like they just did in September. The market was higher a year later. 21 times, like 14% average. When the Fed cuts and then waits a while, like they cut in December last year, then then September this year, so 9 months. I looked all the times they went from 5 months to a year with a cut, then they wait, then they cut again. Take a wild guess where I'm going with this. Market usually does really, really well, up well over double digits a year later, higher the majority of the time. So, we do see, in our opinion at Carson, some potential inflation worries. They're out there. I mean, there are some potential inflation worries. What's the Fed telling us, though? The Fed's saying they're going to keep cutting, right? Go back in history and look at times the Fed cut when there was a little bit of inflation problem. Markets do great. Markets love it, all right? I think that's what gold's sniffing out a little bit as well, that the Fed's going to kind of hyperdrive this stuff. And again, what you said, and I'll last comment on this, who really controls interest rates? Well, it's the Fed chairperson. I know it's a voting mechanism. He's still the one driving the bus. Well, Jerome Powell's term is up in May. He's leaving. We know that. Now, he might stay on the Fed. That's another discussion for another day, but there's going to be a new head of the Fed. We don't know who yet, but the president gets to pick them. Now, they still have to vote on it, go through Congress, but still, who's President Trump going to pick? Clearly, someone who probably leans a little more dovish. Something called the Fed Funds Futures, what the market is expecting. Market's looking for way more cuts next year than what the Fed is saying at the Fed dot plots. I'm not shocked by that because, again, the person in charge is going to be dovish. Sorry, like the weather's kind of nuts around here. How's the weather in Pittsburgh? Is it kind of
just started getting cool and but allergies are ticking up. I know our boys are.
I'm like My voice is
Froggy.
cracking. I'm turning 14 or something live on air with everybody. Yeah, I think it was 80 the other day and it's 40. It's like,
Yeah.
it's just a lot. Anyway, put a bow on it. Yeah, there are more cuts coming. Sonu on our team and other people on our team, we're pretty optimistic about next year too. Next year is a midterm year, usually not that great. Next year, have a new Fed chairperson. Look at history. During the new Fed chairperson, market usually tests the Fed chairperson, tests the market. Markets don't do as well, but we still see reasons with the Fed cutting, with the economy is going to avoid a recession. Next year could be. I can't give our target. We're toying with some targets that are pretty impressive. We think maybe, I'll just say this, maybe double digits again next year could be the play.
Yeah. All right. So I want to wind this up. I know you got some other shows to do. We're both
it's work stuff. No,
okay.
I'd rather talk to you. No, I was on CBC yesterday at 5 a.m. Eastern time. That's rough. I mean, I never know what I'm going to say because my brain's not working yet. But I got through it okay. But no, I'm good there.
We are. So I'm 47. You're almost 47. A couple days, right?
Yeah, I guess so.
We have a 40-year-old and a 41-year-old leading our teams at quarterback this year.
That's true.
And everybody's calling them old, it's kind of hurtful when you hear that, understanding that it's relative to the NFL. But I think these guys are spry at 41 and 40 years old.
Mm-hmm.
How do you see the end of the Steelers and the Bengals season ending up with these two senior leaders? Let's call them that.
Well, given I'm more of a
center.
I'm more of a Cincinnati guy, so I can answer that one a little easier.
Mm-hmm.
We are going to the Jets game. My son just had his 15th birthday. Bought some tickets. So the Jets are like 0-6 or 0-7. They haven't won a game. I hope the Bengals can win that one. The truth is, if you look at Flacco, who the Bengals picked up to fill in when Joe Burrow sneezed and hurt himself again.
Right?
Yeah, he gets hurt. He's like my neighbor. He doesn't live that far away. Trust me, I'm not in Joe Burrow's neighborhood, but he's close to here, and I don't know. He just gets hurt all the time. But Flacco comes in for a couple of games and lights it up. Then the NFL is really smart. The NFL picks it up. I think Flacco might have a couple of good games. He obviously well against the Steelers. We do have good receivers. Yes, our O-line is mid, as my son would say, mid at best is our O-line. Had a good game against the Steelers. Hopefully that continues. I mean, the Bengals are going to peter out. Yeah, I think it's just with Flacco, the NFL is going to catch on. What we're hoping, and hope is not a strategy when it comes to investing, but it is a strategy when it comes to your NFL team. The Bengals can flirt with 500. Joe Burrow comes back in early December. We've got 4, maybe 5 more games. Maybe you win all 5. You win 4 out of 5, and you sneak into the playoffs. That's what we're hoping for as Bengal fans. The next 4 or 5 games Bengals have aren't very good. They played 5 playoff teams in a row, though they lost them all except for your Steelers. So thanks again for letting us win that one. But the truth, their schedule is quote unquote easier. There's no such thing as easy schedule with the NFL, but it is a little bit on paper easier. So we'll see. Again, just win a few more. Be around 500 after 10 games. Hope Burrow comes back sooner than they told us he was going to with his turf toe injury, and then you give it a shot. I know I'm an Ohio State fan too. Thank God gave us Ohio State. They're loaded again. Their defense is awesome. So they make me happy on Saturday, and then I get mad, screaming and yelling on Sunday. It's kind of how that works. But one more thing, real quickly, we're talking markets. This bull market just turned 3 years old, all right? So it's in its 4th year of existence. A lot of people say that's old. Well, much like Joe Flacco and much like, different quarterbacks, maybe age is just a number, like with us. We're old guys.
That's now. It's just number. I feel better every morning.
Exactly. Listen, go back 50 years, everybody. The bull market that made it this far to its 3rd birthday and then forward, the last 5 times, 50 years, had them do this. The average length of the bull market was 8 years. The shortest was 5. One went 11, one went 14. I'm not saying that. You got to go back to 65, 66, the last time a bull market ended in its 4th year. I say bull market's like a cruise ship. Once they get moving, they keep moving. They're hard to slow down, and they're really hard to turn around. Yes, a 100-year pandemic can do it. Yes, major crises can change a bull market in a hurry. Don't see one of those as we laid out. So age is just a number. And one other thing about why we thought this year would be choppy early. The 3rd year of bull markets are usually choppy and volatile. Why is that? Because the first 2 years do great. That sound familiar? We just had a great rally. We needed that reset. We needed to shake the tree a little bit, shake out the weekends. Well, we did that in a big way in April with the near bear market. But the 4th, 5th year usually do pretty darn good after the 3rd year reset. So you put all this together, age is just a number. I don't think this bull market's going to end. I think we get to do this. I mean, I'll come on with you. I'll come on every 6 months if you want. But in a year we do this again, we're probably going to talk about the bull market being 4 and why it probably still has a few tricks up the sleeve. Let's get there. Let's wait till we get there. I'm aware. But we're optimistic again that if you look at these longer cycles, these bull markets last longer than you think. Coupled with earnings, coupled with a dovish Fed, maybe some good news or some of the terrible geopolitical stuff that's out there. Call me a glass half, glass half full type of person, optimistic. Maybe get some good news on some of this stuff, and the market likes that. And we continue to enjoy a global bull market, which if you have a nice diversified portfolio, own some bonds, own some cash, we've got some managed futures, own maybe some Bitcoin or some of the cryptos if you want, but stay overweight equities is still where we'd be. Globally, there's still opportunity out there.
Yep, and I'm with you. I mean, there's always opportunity out there. I take that J.P. Morgan philosophy: when there's blood in the street, get your money in. But there's regardless of market cycle, there's opportunity in there. You could probably tell I just watched The Big Short last night. So
oh, did you? That's a good one. Do you like Margin Call? Do you like Margin Call? You like that
I haven't seen it yet.
You serious? You saw Margin Call with Demi Moore and I don't know who. Margin Call is awesome. That's my favorite movie from the Great Financial Crisis.
Well, the Steelers play tonight, so maybe tomorrow I'll.
Do they? Okay. Yeah, no, Margin Call is a classic. I mean, listen, great show, and I love Wolf of Wall Street. I mean, I know it's not. I think it's funny. Anyway, but my favorite crisis movie of the GFC era, I think Margin Call.
Margin Call. I'll have to put it on.
Really, you'll love it. Let me know what you think.
My
if
all-time
you like Big
favorite.
Short, you'll love it. Big Short's kind of goofy and funny, which is great. That's the whole vibe. I mean, trust me, Christian Bale, he's hilarious, and Steve Carell's a little more serious.
That one
serious, yeah.
When he had dinner with the guy that was writing the synthetic CDOs in Vegas, and he was having that to me was
that was good.
That was my favorite scene, but my all-time favorite stock movie is Boiler Room. I still love what.
Yeah,
my first job out of college, it was a sales role for a steel company, and they showed us that on how to try to learn to sell, not necessarily market. Which
that's kind of like Wall Street 1 in '87. It was supposed to make Wall Street look bad. All it did was spawn all these brokers and I forget his name, whatever Charlie Sheen's name was in the movie.
Bud Fox.
But everybody. Anyway, but real quick little story on that. So that movie came out 2 months before the peak in '87 and the '87 crash, because think about market sentiment. That was the vibe. Well, Wall Street 2 came out. You can look this up. It was either 2011 or 12 with a very negative view on Wall Street. Whereas the one was masters of the universe. Greed is good. Power, money, take over the world. Wall Street 2 was like the anti-Wall Street movie. It really was. It was like green and this and that. Whatever. You go watch it. It was a good one too, but no way. It's nowhere near the first one. But I remember back in the day saying this is a contrarian indicator because people are not optimistic about things. They're still pessimists. There are all those negative movies like Margin Call. Great movie, but it was very negative about Wall Street. Maybe when we start seeing movies about master universe printing money again, then we'll have to be worried from a contrarian point of view. No, I don't invest just based on the movies I see out there. But those are some things that I'm always looking for.
The Hollywood indicator. There we go.
When I travel the country and get to do stuff, Will, maybe we'll wrap it up like this. I love my job. I get to travel the country, work with financial advisors, work with people like yourself, meet with clients, talk about stuff. I'm never asked, wow, Ryan, it is really great out there. How high and long can this thing go? I have never, and listen, I was around at different times. You do get some of those vibes sometimes. I don't know about you. I'm not getting those vibes at all. Doesn't mean we can't have a choppy market or another 10% correction because, hey, they just happen on average, once a year. But that's some stuff I think that's important to remember. Markets don't care about your feelings. Markets don't care about what's happening in the news. Markets care about what's priced in and what's not priced in. Honest to goodness, Will, I still think a lot of bad stuff is being priced in because we're still told how negative it is out there and how divisive it is out there. I think we're going to come together. I think things are going to get better. And we're going to solve some of these major crises around the globe. And earnings are going to do still really well, led by AI. We don't want to talk about AI too much. We'll just say that another day. AI is still a big positive driver. And I think you should still be invested in the market because that way you'll be invested in AI. I mean, Caterpillar's turned into an AI company. Everything's becoming AI. It's coming and it's here. It's here.
And everybody's worried about it replacing them. And I think it's enhancing me. Yeah. It's helping me be better at my job. It's helping me be a better creator. It's helping us grow our business. And I mean, if it replaces me, then maybe I deserve it. But it to me is it's helping us a ton. And to wrap up your last point there, you're right. You're traveling the country. I hope you realize the same thing I do is we are all more alike than we are different. And hopefully these folks in Washington can get their act together and realize that as well and get us back open and move forward and stop playing this finger pointing game and realize that there are guys that are in our military that deserve more than their paycheck, and we can get moving forward again. Ryan, thank you so much for joining us. It's always a pleasure. You're a wealth of information. I would have never even thought about the analogy between Wall Street 1 and 2 and how the markets were.
I didn't plan on bringing it up. Sometimes it just happens, But listen, I'm a huge fan of you. Known you for many years. I know all the stuff you're doing is amazing. All the charity work and helping your son and running all over the place.
This next weekend's the New York City Marathon, and that's going to be the last one for a while. I've got to get back to running this business.
Eat a chocolate cake or two. You've earned it. Take a little break. But Wealth on the Move. I'm a fan. I'm honored to be back the second time. And I look forward to being back the third time whenever you want me. Probably 2020. What would it be 2026? Kind of weird to say. It's kind of weird to say that, but
especially because we don't age. These guys, these quarterbacks are getting older, but we stay the same.
Exactly. Yep.
Check Ryan out on his podcast, Facts Over Feelings. Facts versus Feelings. I said that wrong. I'm sorry. Facts versus Feelings. Mm-hmm. You can always catch him on CNBC, Fox Business, Bloomberg. He's a regular on there. Check him out.
I have a face of radio. They keep bringing me back. Yeah.
Thank you again for doing this, Ryan. And until next time, make sure to keep your wealth moving.
Ryan Dietrick and Carson Wealth. Management are not affiliated with Hoffman Wealth Management and Private Advisor Group.
Will Hoffman offers investment advice through Private Advisor Group, which is a federally registered investment advisor. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult with the appropriate qualified professional prior to making a decision.